Hello, 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 everyone. Good afternoon. Mike Arnold here, co-founder of Path Trading Partners, along with Bob Iacchino. Soon we'll be on a very interesting reversal day. Welcome, welcome, welcome. Good afternoon, George. Though, in which market will they hodl? You're on thin ice there with that comment. Not with the June lows. Well, depending on what market. But the hodl thing. We're not going to stand for hodl. Good afternoon, Davey. Sashi. Martinez recovered. Okay, good. Glad you recovered. Hey, hey, Waka Waka. Sign of the end of days? Oh boy, now Waka's going with the end of days. Oh boy, hey Daniel, hey Jacob. These kind of rallies only happened in 2000 and 2008 from Waka. Hey, Gary, Connor. Wow, that was entertaining as hell from Ted. Anissa here. Good evening, Anissa. Hope everything's well overseas. These intraday reversals are the end of days. Well, what's the time frame for that end of days? Because I need to know that for my bucket list, Waka. All right. All right, by the way, I haven't said this for a couple days. If you are new here, please do subscribe. Ring that bell. Hit the likey button. And we're off to the races. Let me just get Bob on while we go over some stuff. Let me hit the magic. The magic. Didn't we already break the June low in the S&P futures today?
Yep.
George, so the June low, are you talking on a closing base? Because I know we broke the lows easily. Oh, so good after. Oh, John. Oh, at least we got a sane Iacchino in here.
There he is.
John Iacchino in the house. Hey, hey, was the close in the SPY a buy signal? Yes. Off a single candle bar, yes, it is a buy signal. So at decent probabilities. Now I'm going to go through some stuff. We're going to get Bob's thought because, hey, but whatever Bob says goes. Whatever Bob says goes. By the way, look, hey, Bob, when I said 3% Thursday, I was expecting it to be down. Well, we had a net 3%. We were almost up from yesterday's close, the 3%, but we had a 3% reversal. So technically, if you leave it vague like that, you could be on TV because you could always be right. Hey, I said
Yep.
it was a 3% Thursday, didn't give any more specifics. You just might have assumed I meant something else. Do you have any comments on that, Bob? If you leave things vague
Well,
on TV, how it can leave you for the future being able to.
well, first of all, yeah, I mean, so I'll give you an example of that. I mean, you can ask me any question and I have the ability to answer it without actually putting any information in it. So I learned that over, God, a dozen years of doing TV stuff now. It's actually a little longer than that. I did my first TV spot in 1999. Anyway, from that perspective, yeah, I actually have a story about that if we have time for it. But I was on with a JP Morgan analyst who was predicting a particular price in the sterling, and I was predicting a lower price than him. And literally within 2 weeks, it went to my price, turned around, went up, and went to his price. And then I was on with him again about 2 months later, and he kept saying, "See, I was right." Well, I was right too. It's just like we were on TV when I was right. And the host actually did that. So what do you say about that, Bob? I mean, his prediction was correct. I was like, well, I mean, it was at that time, but I had to have money on it, so I needed it to be correct quicker, and it was. But I don't know what they want me to say.
Well,
So yeah, you don't need to know a damn thing to be on TV. I'll tell you that.
so you could even put me on TV then. Hey.
No, because you wouldn't some of the stuff. No, you can't be on TV.
I, I can just be on the YouTube. I cannot be on TV. All right.
I'll give you an example. So, like this morning's live stream, when I talked about CPI, I said I just don't think that we could go positive today. I don't see any way that happens, right? And I could have said that on TV this morning, and then literally you won't be on again for months at a time. And I don't suspect that this morning's low in the S&P, although you guys remember I did have a target of 3,400 on the S&P. And what do we get in the futures? 34 something. Not quite low enough, but 34 something. I think we had a 34 handle, didn't we?
We were down to the low today was only 35.02 in the futures.
Okay. So, well, it doesn't matter. I could come back on a few months later and say I was right, even though I was wrong today, dead wrong. But also, I said I'm not shorting it because it certainly could happen. And if you remember, I don't know if you still have it. You'd probably have trouble finding it. I could text it to you. The number of rallies we had in the 2000 bear market in the NASDAQ, we had 5 of them, with 3 of them over 10%, 2 of them over 20%, and 1 over 45%. So I'll send it to you again really quick, Mike. You get some of the sharpest rallies in bear markets, and I still don't think that the long-term low is in, but I'm going to stick to my prediction of the fourth quarter being positive was a much more balanced and researched prediction than my prediction this morning that we wouldn't go positive on the day.
Well, you texted me something. Let's see. This is the rallies during the 2000 bear. Yeah, 35, and this is the NASDAQ. 35, 12, 25, 41, 45.
Right.
So, yeah.
Very dramatic rallies. So you got to be careful about what you see. I saw some guys going on there saying, oh, the plunge protection team must be involved. I'm not sure it was that. I think it might. I know Mike's. Look at Mike's face on the plunge protection team.
Hold on. I got that same thing. That was from the retail side today. This must be the plunge protection team, and it was not the plunge protection team. By the way, can I interject a couple things? Because this is interesting. Please. From the professional side, we had some of the largest buy programs launched today for the year. And we may have had the second or third largest buy program ever launched today. Now, those are automated programs. For people who don't know, that's when they're essentially preloaded and they're automatically executed. There's no discretion. It is sweep buys across massive amounts of securities with very large positions. Not even price sensitive.
They're also longer term holds in the most.
Yes, that's why I'm going to give, if we have some time and if people like supporting the channel, I will actually give the program Puke Point, because there actually is a program Puke Point that's pretty reliable. So we had some of the most massive, or is from especially this year, buy programs execute. There was also we got from the professional side, this was the no-brainer after we spiked below the cash 50% retracement from the COVID lows. This was the no-brainer from not only the 200 EPS, 15 times earnings, a no-brainer buy 3,500, 50% retracement from the COVID lows. This is the no-brainer. I'm going to keep saying this because I heard it multiple times. No-brainer, guaranteed rally for the end of the year buying opportunity. Which, yes, gives me, this was a daily buy signal. I think we will continue, and I will give my stop points a continued rally for a short term. However, once I heard the phrase no-brainer multiple times from the professional side, I put pause even with that there. for the end of the year. Not saying we can't get a rally. I think we are overdue. We have cycles at the bottom. This was a very bullish day. There's still money to be put at work. The other thing was we have a lot of money over the next couple weeks to be put to work because fourth quarter is going to make the year for us. That okay. I think it can sustain a rally. You know, we always have to trade price action. I can sustain a rally, but when I hear things like guarantee fourth quarter is going to make the year for us, everything else, and it's all being banked right now, it's like everybody's running to one side of the boat.
Yeah. That's part of what today was, right? I mean, so look at it from this perspective. And this is actually something I said this morning. I just didn't think it would snap back in one day. George, I don't need to be redeemed. I'll be redeemed after the fourth quarter is positive, George. By the way, I've got Lauren's mafia name. Who else did I owe a mafia name to?
See, I thought you were going to write that down.
Gary.
Gary, you owe Gary a mafia name. If Bob owes you a mafia name, you got to type it in because you got to make good on that.
Yeah, Gary's the golfer. Gary the golfer. His
Gary,
name sounds like golfer, so that's his mafia name, Gary the golfer.
I hope you play golf,
And
Gary.
there actually was a Salvatore the golfer Avellino in the actual mafia that doesn't exist. If you think about today, something I said this morning, and we talked about it when Mike put up the probabilities of the 75 basis point rate hike. So if you go along the sort of path of all those different probabilities of what the market is pricing in, they went from a tiny probability of a 50 basis point rate hike and a massive probability of a 75 in November to a guaranteed 75 probability, which could change, but if it stays at this level, it's a done deal, and a slight probability of 100. So they took the 50 completely out. The highest probability now for December is another 75.
Yep.
It's only in the 50% range or so, but it's another 75. And now if you start to go out the curve, they've started to take rate cuts out. Okay, if you'd have to go out the curve and do hit the compare tab, and you can see the probabilities of the rates of the Fed funds rates starting to drop. Probability of the Fed holding after these next two rate hikes, they've got a decent chance of a February rate hike priced in. But then after February, you start to see stability in the rates, which means that the market is starting to believe the Fed. The second thing you see is the 2's 10's inversion getting even worse. Okay, it's getting way worse. 51, I think it was at today, last I looked.
51.
Okay, so recessionary, and a recession actually isn't necessarily bad for stocks. Stagflation is. So the market is starting to believe a couple of things. Number one is starting to believe the Fed. Okay, and they're starting to take the rate cuts out of the market. Number two, they're starting to say those rate cuts will actually work on inflation and drive us into a recession while at the same time lowering inflation, which is good for stocks. Now, that obviously doesn't explain in and of itself the kind of snapback we saw today. The price action and Mike's conversation about the program buying explains it a lot better. Coco just asked if I'm long or short. As of this morning, Coco, I said I wasn't going to trade it, so I'm neither. And I didn't trade it today at all. I don't have anything of note on other than a long-term long gold position, and a lot of it's physical gold, if I'm being honest. But from that particular perspective, you look at it and you think, okay, so they're starting to price out stagflation, which, as we mentioned before, 70s, 80s, when we have a slowing economy and persistent inflation, that's when the market doesn't perform during a recession. So stagflation is a recession or a severely underperforming economy while inflation is still present and elevated. And I still think that's my base case for the economy, which is the worst condition for the economy possible. Real wages still negative. So everybody's wages that are all of the wage increases people got, they're not worth anything yet. They're still negative, in other words. They're worth something. But you're still losing money versus inflation, which likely means, my brother's not going to be happy to hear this, people are going to be asking for more raises. They're going to be asking for higher wages simply because they're still going to be struggling to make ends meet. All right. Now let's take that out a step further. If there's stagflation, let me rephrase this right now. I'm going to give the Fed, and I said this on one of my TV interviews today, I'm going to give the Fed the most latitude possible. And let's look at PCE, not CPI. Okay. And let's look at core PCE. All right. Core PCE instead of core CPI. Okay. If core PCE was cut in half, okay, and the unemployment rate doubled, you'd basically have core PCE year over year at about 3.5%, and you'd have the unemployment rate at about 7%. How's that going to feel to the Fed and to people? You're still going to be 1.5% over their target for stable prices, and you're going to have 7% unemployment and rising. So that's just kind of an illustration of how bad they actually let things get. And I'm not simply a Fed blamer at all. It has a lot to do with one of the things that Sterling and I talked about today. Okay, you got to put my brother's comment on because I have a comment about that. Something Sterling and I talked about offline today is that Social Security is getting an over 8% bump with the CPI adjustment. That's automatic. That's built into the system. And there's other places that's built in. And generally that stuff takes place at year end. So there's going to be all these other bump ups. And that in a very organic way fights the Fed because it's more money that's going to be spent into an economy that's already pushing. In terms of what my brother just said here, they don't have to ask. We are raising pay to retain our current staff and offering more to hire additional staff. So, and John, you can correct me if I'm wrong on this on your individual business, but in a broader scope, when companies are raising wages preemptively, implicit in that is future price hikes. Because generally you haven't hiked prices enough. When you're going out there and saying, look, we'll just give you some money for you guys to stay, you haven't hiked prices to offset that yet. And this is something that Cameron Dawson pointed out to me and showed me a bunch of data on it. She said that you don't raise wages unless you think you can cover it. And in a lot of cases, implicit in that covering it is more price increases down the road. There's his answer. So, more price hikes are coming. And not just in food and medicine and insurance, it's going to be in my brother's in the food business. So, yeah, that's where we're at.
So, John, you're hiring. I can throw in the towel on all this Ponzi market stuff and go work with you, John?
It's a long drive, Mike, but you'd be fed well.
Well, fantastic. As long as it doesn't spike my blood sugar, I'm fine.
I don't know. I can't promise you that.
Oh, by the way, we all have to give a shout out to George. $5 super chat. If my portfolio is the 1940s U.S. military, then I just won the Battle of Midway. Thanks to Mike and Bob. Thanks for helping me crack the enemy code. Never quite looked at it as cracking the enemy code, but that's an interesting way to put it.
George gets a mafia name. It's Puddin'.
Puddin'?
Yeah. Georgie Porgy Puddin' Pie. He gets Puddin'. That's his mafia.
How am I going to remember all these? I have enough trouble remembering
the golfer. We got Puddin'. We got Teddy Ferrari.
Oh.
I don't even remember the other ones.
See, I can't even remember people's pronouns. How am I supposed to remember their mafia names?
Pronouns. I'm going to give everybody a pronoun now. All right.
Waka says the market's got it all wrong all year. The bonds, however, have had it right, and they are not believing this pump.
Well, I mean, the bonds acted like they kind of acted like they were. I mean,
Earlier they were.
yeah, bond yields jacked up, but then they went lower. So, yeah, the combination of those things, you'd be right on that. So,
But longer term, no. The bond market is, I think, is still discounting this. But you have a lot of money still sitting there. By the way, just to recap everything, to make sure we touch on everything, we got retail sales an hour before the open tomorrow. I want to see if Bob has any thoughts on retail sales. We got preliminary consumer sentiment after the open, 30 minutes, and business inventories. That's what's coming out real green across the board. If you were red, pretty much every sector up today. Energy leading the charge at 3.86%, followed by financials. We already covered the Fed, still in negative gamma territory. Fear and greed almost ready to pop out of extreme fear on this little bounce up. Also, remember Friday. We have banks kicking off the financial sector earnings tomorrow. JP Morgan, Morgan Stanley, Citibank, Wells, US Bancorp, PNC, and First Republic. All tomorrow morning. So, Bob, any thoughts on retail sales, preliminary consumer sentiment, or earnings from the banks?
well, first of all, everybody learn what they can from Mike because my brother just hired him. So this channel will be going away.
Oh, yes. I have a job now.
Yeah, I do have one comment on retail sales. I think retail sales is going to be weak. Remember, guys, it's inflation. It's not inflation adjusted. So prices are going up, but the retail sector is one of the places where prices have kind of leveled off. Inventory builds have been very dramatic. A lot of retail companies managed their inventory fairly well, built up inventory prior to the supply chain collapse, and then were surprised that it didn't all sell. So they have been discounting somewhat. So it wouldn't surprise me if retail sales missed, but it won't mean that much because it's not inflation adjusted. If it beats, inflation will be blamed. You have to go down to the Fred website and actually look at retail pricing after the number, and they also put out an inflation adjusted retail sales a couple days later, and that actually matters more.
Any thoughts on bank or financial sector's earnings for third quarter?
Georgie Puddin's got to get thrown out if he uses hodl again. What'd you say, Mike? Bank earnings?
Bank earnings kicking off tomorrow.
Bank earnings, I think the trading will be poor. The trading results will be poor. They're obviously going to have fewer loan gains. That would affect somebody like a Bank of America or Wells Fargo. But I'm going to defer to Emma Mullman, who said it's going to be very ugly. She's an actual analyst she's not a bank analyst, but she analyzes the sectors like that. I don't. So I'm going to go ahead and lean on her and say that bank earnings will be weak, but I don't honestly have an opinion myself.
Okay. Joe the Market Maker, what do you guys do for a living? This?
Ooh, this?
Not just you two, but the markets? This? I don't know how to answer that. That's it's been a long time. We are not newcomers to the financial scene.
No.
No.
Combined what, Mike? 61 years, somewhere in that range?
Yeah, it's a long time.
Yeah.
It's longer than I can even remember points. Options 22. Mike, last time the S&P SPY crossed and closed above the 62.5 level, it was a buy trigger and they took the market down hard. Seems like the technical buys or sells opposite is happening, i.e. today of down well, again,
I can't
you
understand.
put a lot in there. We have a buy based off the close today, based off a one candle pattern, and there is a stop, and I'll go over that. Other than that, it's not all. I would not agree with your statement. Less than a cost closed above. Yes, again, you have probabilities of the 62.5, which are around that 70% on a daily basis, but that leaves 30% that don't work. But you can't make a it's like when I talked about last week, people saying, "Oh, because the a double bottom didn't work in a down market, doubles don't work in down markets." You can't make sweeping conclusions from limited results.
Right.
Period. So that period. So you can't say, well, it didn't work last time or it didn't work the last two times. And we've seen that repeatedly. And things do cluster. It's the nature of signals. Sometimes they do cluster, but you don't know if you knew beforehand which were going to work and which weren't. A, there wouldn't be probabilities involved because you'd already know.
Mike
And
wouldn't be
B,
using the word probability; he would be using the word assuredly.
yes, that's my caveat, especially even from the professional side today, where this was the no brainer low for the rest of the year. All right, so this is a guaranteed. Is it? When I hear anything guaranteed, it's there's a probability that this is a low. Is it the low? No. And by the way, why this wasn't, because I kept getting this repeatedly today also. I don't know if you got this. This was capitulation. No. Capitulation is when stuff gets puked out and then you get the buying. There was no puking. There was some a little futures puking going into the open, but this was not people throwing in the towel.
I'll tell you a quick story on guaranteed, and then if there's no more questions for me, I'll jump off and let Mike handle what he needs to handle. I remember being approached in the 90s by a guy who was selling principal guaranteed notes. Mike knows this story. He was like, you get an 8% return, your principal's guaranteed. So even if they go belly up on the return, you get your money back. There's no risk. And I said, well, what do you want me to do with this? He said, try and sell it to your clients. I said, well, it's who's guaranteeing it? What's the guarantee? And he goes, well, that's guaranteed by Lehman Brothers. And I said, well, that's not guaranteed. And he goes, well, Lehman Brothers isn't going out of business. It's a true story. It's a true story.
Oops.
Sure enough, 10 years later, a bunch of principal guaranteed notes were no longer guaranteed. Now, it wasn't an annuity. It was a special bond offering with an 8% return with a guaranteed principal. It wasn't like an annuity. It was literally a bond that they were backing with their own insolvency.
Hold on. Hold on. We'll get to some more. Got it. Only 70%. Only 70% accurate. Understood. Well, I'm sorry. I do not have anything at 100% accuracy. And anybody who says they do is lying.
Yeah, they're lying. If they tell you 97%, they're lying.
No,
That's how we knew
I
Tom
have
was.
seen some people who trade systems that are around 96, 97. What they're doing is selling massively out of the money
Yeah. Okay,
puts.
let me rephrase that. With a positive money factor, and they're not, and they're on YouTube.
You know what? But when they're wrong, they take a bloodbath,
Yeah.
a literal bloodbath.
Yeah. They have to have a positive money factor with it as well. Then I'm guaranteeing you they're lying.
Here we got from Joe, the market maker, who I'm wondering about the market maker title. You guys look like mafia members, the Baldwin Russian mafia and the with the beard Italian mafia. Well, I am not Russian.
I'm offended by you saying I look like Italian mafia. I am Swedish.
No, you're Italian.
Yeah, I'm 100% Italian.
Uh, you know what's nice about working from home and not having to work for a big firm is you can wear a tie dye and look like mafia. Okay, that's one of the luxuries. And there's no way I'm getting dressed up in anything resembling fancy formal wear to get on YouTube. It not happening. So, but Bob, I mean, what you got tattoos, Bob? What's up with that?
I mean, they're not Italian tattoos, that's for sure.
People, you can.
When
There's
my
lots
when
of
my dad
market
saw
for.
my first tattoo, he said to me, "I made you good, and then you ruined yourself." I go, "Oh, you made me." Okay.
And we can't judge the package by its looks, especially in this day and age of wokeism, can we, Bob?
No. Um, I have to answer Gary the golfer's quote here. Um, there was a guy years ago called Billy Badminton. Okay. And he got that nickname because he killed a guy, beat him to death with a badminton racket. Now I assume somewhere in there the head broke off and he stabbed him with it, but you can take Gary the golfer however you want, Gary.
Look, I mean, hey, you got, or we could just. There's a lot of things you could do with the golfing. A lot of things. All
Coco
right,
gets a mafia name. It's Coco the idiot.
Coco. Oh no.
I love you, Coco. I gotta go, guys.
One other question for before you leave. Dr. Michael,
Oh,
repercussions to Saudi Arabia since Biden is reconsidering their relationship. And although, what are the thoughts? Anything on oil right now? Then
okay.
we'll let you
So
go.
first of all, if you look at the weekly chart of oil, and I don't trade this, but we retraced almost exactly 62.5% of the uh, prior week's rally, and then we popped up above it, so we didn't close below it. It's gone into the rotation zone, but the rotation zone hasn't flipped. So I'm still more likely. I lean more towards short. EIA today showed refinery utilization dropping below 90, 89 percent and change. Actually, I've got it right here, 89.9%. That's been a trend on refinery utilization. For any of you guys that have heard me talk about crude oil before, refinery utilization is a really good short term indicator of demand on the ground because if the refineries aren't trying to get crude oil through and refine it, it's likely because they've got some stockpiles of it. And the build that we saw in the commercial crude inventories today was only about a million, 1.9 million more than the SPR release. So basically, the release it was the entire build. But gasoline inventories increased by 2 million barrels, again, pointing to the refinery utilization weakness. Now, from a perspective of the thoughts on what Biden said about Saudi Arabia, this is rhetoric. The last thing you want to do is take a country who, in actuality, defied you and voted to cut production, although I said this morning it's not that really that big of a production cut. And in theory, convince the other OPEC members to vote for this production cut. That's just rhetoric out there. I don't know that that's confirmed. It's from anonymous sources. And say, we're going to punish you for doing that because guess what they're going to do next? They're going to cut it even more. So if you try to harm them at a time when our production is peaked, and there's no capex going into our production nor our transmission mechanisms for any oil that might come out of the ground. That's just, it's either rhetoric, nefarious, or just the single dumbest thing I've ever heard. So that's my reaction to it. And I've heard some dumb things. I mean, my brother and I grew up around some dumb guys. And this is probably the dumbest thing I've ever heard. So there you go.
And tell us what you really think, Bob.
That's what I really think.
And that's probably a good note to leave it on. Besides, you look like a character, not me, but you, Bob, look like a character from GTA 5,
What's GTA 5?
the video
Oh,
game.
Grand Theft Auto?
Yeah.
Well, that is a compliment I'll take. I'll take that. Hop out of the car and beat me up with a bat, that kind of thing. One of those guys. These are not Italian tattoos at all. This is a Chicago flag. I guess that could be misconstrued. All right, I got to go.
All right. We'll talk to you later, Bob.
Cheers, guys.
Okay, just me back. Thank you. Everything. Interesting fact: the Fed banned Fed members from stock trading on 10/21/21. Nasdaq is. Nah, that has nothing to do with it, Sterling. Nothing to do with it. You know that. At least you should know that. We're not going to that. So, boy, we're Josh checking in from Texas this week. Looking forward to watching the replay as soon as I can. All right. So where do we sit? By the way, on this candle, because I said before, earlier today, you watch for that close in the 12% from the single candle that has a very decent probability of a bottom. The stop has to be below 35.75. There are potential pullback points to this, but that's the stop that I've tested out. And it has held. It just, well, I've done, when people wonder, well, why is everything based off harmonics? Because I'm not trying to fine tune if it's 63%, 61%. I get into a range, and the harmonics have been the most reliable ranges I have found. That way I don't have to say, well, for the candle in the S&P, you need 63.8%. Or for the NASDAQ, you need 61.1%. No, I'm going, and the ranges, remember, don't curve fit. So you're trying to find a bubble range, and it's easy. That's why I've tailored everything. First off, from the research, the harmonics were the most reputable pivot points in the market. So then I've developed the system utilizing those levels and testing out levels around them to see fall-offs. That's how stuff is developed from a systematic standpoint. So we did close in the upper 12.5%, which is a very bullish close. Your major support is back at 36.27. You want to know, here's a little thing you won't hear from many people when you have massive program buying. Make note of the VWAP for today. This does not hold for tomorrow, though, if we do get a pullback. But you start for a one-day pullback. But going forward, it's 3608. It's an area. So I'm just, in my notes, it's 3600. Also, based off this single candle rally, look at the 50% point, 3600. My stop would still be below 3575. However, the program puke point is noted with program trading. The VWAP, and this is in the vicinity. It's not a little hard line, so I make note of this area, and since it's so close to 3600, my notes are just off 3600. We get a daily close below that key VWAP area, and this is when a bunch of the programs went off, as confirmed by the tick. The tick with these were programs right in here. These massive, this is NYSE cumulative tick. These spikes above 1500 were massive program buying. So if we look at the times for that, 10:05, you come back, 10:05 with the breakout thing that I covered on the midday update, programs. This was not a program. These were program candles right in here. program candle. Uh, so my puke point for the programs is a daily close, roughly. Don't get silly and go, oh, it's 3608.75. It's below 3600. Program puke point, and that will not change. So don't write down today, October 13th, program puke point, because we roll over next week or the week after and get a daily close below program puke point. You generally start to see the programs puking back out. It's a point in time VWAP. It's not, oh, we on Monday we were back below the VWAP on a daily basis. No, it's 3,600. You want to make note of, because that's the line in the sand for a lot of these longer term programs. That's a key line in the sand. Remember, these aren't short term trades. These are long term establishing. That's why they were not price sensitive. That's why you saw massive buying. It wasn't, we're going to work orders all day along the VWAP. No, this was, we're going to execute a broad spectrum of buy across a range of stocks and buy it and lift all the offers. We're just going to start lifting those offers. Okay? It wasn't price sensitive. All right, we're going to work orders. No, this was not order flow working. These were buy programs. How long will this rally last till it's over? I don't know yet. It's not the bottom, at least based off of any stats I follow. And wouldn't that be a doozy for all the no-brainer trades? That's why, from my perspective, it's still trailing a stop. The initial stop off this single bar, and people say, oh, that's so far away. Not really if you position size. Remember, you vary your position based off the risk you are taking. So your position, if the stop goes farther away, your position size gets smaller, at least if you're trying to do things from a professional level. If you're trying to do things from an idiot level, you'll always trade the same position size. But then, and I'm not talking about different systems having different position sizes. I'm talking about, let's just take into account just one system. If you're constantly trading, unless the stop for every execution is the same, which I hope it's not, because that does not take into account volatility, and some of the worst stop systems I've ever seen don't take into account volatility. And I don't know how you have any reliable measure, and even harmonics take in volatility. Why? Because the wider the range, the farther to stop. The narrower range, naturally, the tighter to stop. But if you're always taking the same order size, position size per trade, and your stops varying per trade, as it should, then on the times your stops farther away with the same position size, you're naturally going to lose more. However, your probabilities didn't change. So you're taking bigger losses, which can drastically skew, even if you're, look, I've seen people trade 70%, 80% systems and lose money. Why? Because they don't use proper position sizing, and they ramp up their risk at the wrong times. So guess what? Let's say you had a 90% right system and you risk just $100. Let's just call it 1-to-1 reward to risk. I'm just making the math easy here for a point of teaching. So we're going to take 10 trades, 90% right. I'm really simplifying this. The first 9 trades are all winners. It was risk 100 to make 100. You made $900, 9 trades in a row. You're getting real confident. This system's it's guaranteed. So you up your bet on the next one to 1,000. That was the loser. Yeah, well, 9 out of 10 winners. You varied your bet size. The one you went balls to the wall risk was the loser. You just were right 90% of the time, and you still ended up with $100 down. You may say that's a silly example. Seen it way more with a lot of very smart people varying their bet size. So you don't know which one's right. And if you did, then that would change the probabilities and you'd be changing a different system. And for anybody who tries to argue, oh, I knew this one would be a winner, you did, then why didn't you take all your money and put it on that one trade? If you knew it was going to be a winner. Because you didn't. It'd be even a stupid thing to do to take all your money, even with the 90% get. Hey, 90% of the time it's right. You're going to take every cent you own and put it on one trade. Hey, every cent. If it's that one in 10, you just blew your whole. There's no coming back. Well, now you have to earn the money back, but there's no trading the money back. You just blew your account out. Okay. By the way, I saw a question on tick and trim. We'll have to keep reviewing that. By the way, if you want to know more, I saw a question. Who was that? So I think based off probabilities, by the way, we have pretty substantial probabilities, even if we retest some of these pullback areas, that we could see still a strong October. I think people are banking a little too much, and this is my thought. Remember, the long-term system, this is why I follow systems, are way off from triggering any buy. We did not get a medium-term buy. This would just be a swing trade buy. I saw something about where was it? About tick, trin, and some other stuff. By the way, you want to know some things, go back and watch my live lunch stream from today. I cover VIX and tick. Trin we'll have to get into at a different time. Apple bullish divergence on a daily chart. By the way, we had the nice gap fill plays in a bunch of stocks today. Daily divergence. By the way, the double off the table never triggered, but never now is invalid. Next play, daily divergence. Yes, it is a daily divergence. It is I'd have to modify. It's not a modified percent B. It might actually be a standard percent B buy. I just don't have that on here right now. I'd watch for follow through, and this just isn't for tomorrow, for that gap fill left behind and the return to the daily rotation zone. That would be the next key area. Actually, I want to see this. I didn't have a chance to do this before. Wanted to see where that 62.5 is, because if you're looking for any stop also, where's your stop going to be just from swing percentage? Right there, lining up with the single candle 62.5. Would that be a stop I'd use for a gap play? No, because our reward to risk would not be right. But for a longer term swing, yes. What percentage do you estimate they will sell? Well, you start getting below the 3,600 on a daily closing basis, it would be a fair amount. That's why it's a puke point. And that's a daily closing basis, not an intraday basis. For bringing up the volume aspect, yes, it was a very strong volume day, which also leads to, as long as we hold these key levels, leads to short-term follow-through. with also daily cycles turning up, weekly cycles turning up. Also, from the weekly perspective, remember on the futures, the weekly, though it's funny because also look at where your weekly 200 is. And remember, that's the simple moving average. On the futures, the weekly 200 is at 3,600. Just happens to work out that way. And we have not had a close below the weekly 200, at least yet. If we puke something tomorrow, could happen. Unless banks really blow it and everybody turns into a net seller, which would be against the probabilities, but that's why you trade with stops. That's why you always trade with stops. Did not say that, Coco. How did I hone my technical trading skills? Ton of testing and research. Thousands of hours of it. Thousands. Remember, I've been doing this a very long time. But this is thousands of hours of work. Can the buy programs trigger the bigger sell? It won't be triggered tomorrow from the buy programs today. But I told you what the stop point is. From this, just separate from the buy programs. The buy programs you have to give more than one day. They're not triggered the next day. For the medium term, these weren't short-term buy programs. These were putting money to work, and there is a lot more money still sitting on the sidelines to be put to work. Please keep that in mind. Longer term, I am very bearish. Unless we were to close tomorrow below that 62.5, I will remain bullish. 35.75, the 50%, again, 3,600. Why am I using 35.75 for a stop level? Because that's based off the system of single candle harmonics. You also have the key lines that are still on here that I put up yesterday from the breakout and breakdown points. We're above the breakout points, so even on a pullback tonight, your key support is 36.27. Your first cross of the rotation zone, remember we don't trade crosses, I watch for that with confirming price action though, is 36.27. You even have a support point in front of there at this point. You have a support point of 36.41. Also remember, we closed into a clear path move to the upside. There's very little resistance. I talked about this before. We have the next breakdown point is 37.42. The key closing point on a rally tomorrow I will be watching is 37.03.75. Why? Because from this down move, that's the 62.5. I get a close above there. Minor 37.42, stop reduction break, and this is the breakdown point, but that's your next harmonic. And then the probabilities are for a return to 37.81 to 38.20 area. So if we close tomorrow above 37.03, going into next week, those are my targets. Really? Bearish divergence on 5 minute. Fantastic. No, I've been bald since before trading. I've been shaving my head for many, many years. Yes, bank earnings are still a key tomorrow. All right, I'm going to leave it at that. Just glancing back at the notes to see if there's anything else I have to say. Nope. Although we have a nice breakdown and breakout and breakdown point. 111.19, 111.18 for a breakout. I'll break down back to 10.17. I saw that. I don't know how Elon can noted. He tweet out noted. Still, I mean, a little push below there, but the snapback thing there, we should also see a follow through rally for all those Tesla. This triggered the a buy, so we should see a continued push higher. Remember, Elon, if he's got to fund more with the Twitter purchase, cannot sell till after earnings, which is on the 19th, which what is next Wednesday. Please keep that in mind so you could see a continued rally in Tesla. I don't know how. I mean, that's why there's no enforcement, and we're supposed to take his Twitter as official Tesla commentary. So you're saying, hey, I'm gonna. That's again shouldn't be allowed, but doesn't matter. Doesn't matter what I think. Doesn't matter at all. You're welcome, Christoph. You're welcome, Anissa. Why laughing? I feel like I'm stupid. It's a 5 minute going into Asian. You're not stupid, but a 5 minute divergence does not really matter. Don't take it. A 5 minute divergence up here has already played out. You had a 5 minute divergence. It's already over going into the close. You got to look at bigger time frames now going into Asian and European session. Don't feel stupid. I mean, if we're talking about something during the active trading day, that's fine. But your key level now, a 5 minute is not going to, especially with going into the futures close and reopen, forget it. Little Now, if you said you have a little mini double top here, different story. And yes, but that's just a pullback into the Asian session. Potential. Even the European session. All right. See, boom. Would be to a 3650 key support area. Would I be surprised to see a pullback going into Asia / early Europe? No, I would not. But that's just a pullback into after a massive rally. Now I am wrapping it up. Hopefully people will tune in tomorrow morning. With that, sorry we didn't get through every market, but we've already gone over an hour today and I have things to do. So that's where we stand. I shall talk to everyone tomorrow morning. Bye.